So definitely some liquidity could get sucked out of the market. One stock that we're going to focus on right now in a bit is Happiest Minds. If you had invested in that stock a year ago, you would have definitely had a happy mind today. I mean, a year ago it was 349 rupees, and look where it's at today, which means that from 12 months back to now, you would have more than tripled your money, 3.6x to be precise. To be fair, it's also had a very, very strong quarter. So if you look at the numbers this time around as well, the dollar revenue growth came in at 8%. It definitely is industry-leading growth on a quarter-on-quarter basis, and it's a 45% year-on-year growth that we've seen. So Happiest Mind is one of the strongest players there, and the management has told us that the demand environment is very strong. Let's get the management, in fact, on board. Joseph Anantharaju, the Executive Vice Chairman and the CEO, Product Engineering Services, and Venkatraman Narayanan, the Managing Director and CFO of the company, is with us. Gentlemen, afternoon to both of you, and thank you for being with us on the channel. Joseph, I want to start with you. Your investors definitely are happy with the kind of run-up that we've seen in the stock, as well as the, exemplary performance. But I just want to ask you about what the growth triggers could be here on. Because in the first half of the year, the revenue growth of 43% was boosted by a low base from last year and also by the acquisition of PGS. Now, henceforth, what could the growth triggers be, and what could a realistic growth assumption be for the full year? Will you continue to be industry leading?
So, from a point of view of growth triggers, I see, I would put it in three different ways, Ekta. The first is, if you look at the digital spend, that continues to be very strong, and it's cutting across verticals with, I would say, all the verticals that we are, as you would see from our results, all the verticals have exhibited strong growth in the last quarter. The other element is the pent-up demand, and we see that continuing to play out because customers had held back last year, and we think that between the two of them, the demand will get sustained at the current levels for the next 12 to 18 months. If you look at it from a geo perspective, this year we've had Middle East come up really strong. We're seeing a fair bit of demand, so that will be one of the growth drivers. Europe has shaped up quite well, and we're seeing a good build-up of pipeline, which should help us sustain our growth. US continues to do, North America continues to do well and should act as the anchor for our performance and growth.
Okay. All right. Venkat, just coming to the margins bit, your guidance in terms of margins was 22 to 24%, including other income. But overall, your margins, it seems, has declined in the past 2 to 3 quarters. I think you did around 25% just a couple of quarters in Q4 of FY21. So where do you stand in terms of margins as of now, and does this guidance hold?
So the first quarter of this year, we did about 26.1%, like you rightly pointed out. This quarter, we have come in at about 25.6%. So I'm talking about EBITDA numbers right now. But there was a one-time cost of about 1.4 crores, which was a contribution under a compassion scheme, which we had for our employees, and that added about 1.4 crores in terms of cost to this quarter. So if you adjust for that, we are back to the 26.3, 26.2% EBITDA number that we have been showing the last quarter. When you look at PAT, the impact of taxation is, I would say, it has been different year over year. Last year we had tax credits, we had brought forward losses and all of that, which led to about 20% was our average tax rate. But now, from this year onwards, we are a full tax paying at full rates at 25.1%. We are paying taxes. So that's been on the margin front. And again, like you pointed out, 22 to 24 has been some sort of a guidance that we've been giving on the margins, sustainable basis. But we have been beating that for the last 4-5 quarters now. And we would like to continue that trend. But some of the cost benefits that came out because of work from home and lower travel, reduced travel, visa costs, are likely to slowly return as we come back to work in a limited manner from January.
Okay, that's on the cost and the margin side. Venkatraman, I also wanted to ask you a little bit about what's happening with the deal size, because you generally don't disclose the deal wins to us, the deal win number. So how do we understand what the deal size has been for the company? Is it much better than last year, better than 6 months ago? If you can just give us some more color on that.
Yeah. So we've got two numbers that we have to look at when we talk about deals, new deals. One is a repeat business. About 87 to 88% of our business comes from existing customers. So there we are actually growing deeper and we are going into depth with our existing customers. As far as new customers are concerned, we have been following the land and expand kind of a strategy. So yes, you can talk about what's your sweet spot. Sweet spot to be $1 million or $1.5 million is the kind of deals that we start with. But then over a period of time, the effort is to take them up the $1 million chain. So we have got $31 million clients right now. We are slowly moving them up the chain of size. If you have noticed this year, from $3 to $5 million range, the $5 to $10 million customers have become from 3 to 6. So 3 customers in that range have become 6 this time. And that's how we progress on the land and expand strategy, which is followed by an in-depth account mining and account management process that we have in place. Average revenue per customer has also been slowly going up. And this time, year over year, we have shown an increase of $124,000 per customer. We are at about $784,000, which is a real point that we focus on. So we've got 180 customers. You slowly get in, you expand, you make them grow up the chain in terms of $1 million customers, and you also keep on consistently increasing the average revenue per customer. Okay. So that's what we are focused on.
Okay. All right. So that's an important metric, that your revenue per customer has risen from $750,000 odd in the previous quarter to $780,000 odd this quarter. So that's an important metric to track. But Joseph, Venkat spoke a little bit in terms of the deal wins that we've seen. But if you could give us some numbers in terms of the $1 million customers that you added, I think it was 5 in the previous quarter, and the $1 billion customers that you added in this quarter as compared to the previous quarter, and what can we probably expect in the second half in terms of additions?
I would say, as we reported in our press release, where we listed a few of our wins that stand out. The 2 things that I wanted to point out is a few of these deals. If you look at the global supplier of mechanical electric drive systems, where we help them with their digital platform, or for the largest brokers of fine and decorative art, we've taken an approach where we've gone in and helped them with their initial, through a consulting exercise, help them visualize their roadmap. And once you do that, you're able to become a partner to the customer, and you're part of the implementation and subsequent releases and subsequent initiatives that they have. So this is something that's helping us, and it's also cutting across multiple geos. 3 of the wins are in Europe, 3 are in North America, and 3 are in India. So which really sets us up well for the second half of the year, both in terms of how these revenues grow from these customers, and also it's indicative of the pipeline that's been built, which should extend into the second half of the year as well, sure, in terms of closures.
Okay, Venkatraman and Joseph, thank you so much for stopping by and speaking about Happiest Minds, and hope you continue to grow wealth for your shareholders and simultaneously grow your own company as well. Thanks a lot for joining in. That's Happiest Mind. They are facing some margin pressure, but growth is good. Before we head into a break, here's something that you, our viewers, must take note of. CNBC